Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or in any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, New York coffee. Okay, so, and this is a long one, I'm afraid. So I said 7 weeks ago, and I quote, looking below, we have a congestion area at the moment around the short medium moving average between 309.90 to 312.85, containing the 50% Fibonacci line of the May 24 to February 25 move at 310.80. Below this, we have a large stratified series of supports starting at 290.85 and stretching down to at most 252.25. End of quote. The reason I mentioned these back then at what are now levels some distance below is that, as I also said 7 weeks ago, and I quote, one new pattern has developed and two new patterns have started to develop. The easiest to see is the possible monthly key reversal we have on the cards for August, end of quote. Well, this pattern did develop into a monthly key reversal up for August, for which we have seen a follow-on higher in September, and even now with changeover, we have seen prices try higher, but from a lower level. I carried on back then and I quote, the second possible pattern, and this is not clear yet here, as it is in London, it's not clear here as it is in London coffee futures, but we might have formed a June or possibly late April to date descending scallop pattern. This looks like a backward letter J on my daily chart. We now need to watch out to see whether the market turns lower or heads higher. I suspect this pattern is coming to a climax and would then be able to give some idea of the move, either higher or lower. This pattern has become more real in recent weeks with the peak of the upswinging inverted letter J. This, and that's the end of the quote, this descending scallop pattern became a triple quad bottom, and the subsequent move up from the descending scallop pattern became an ascending scallop pattern from late July till last week. Well, till 3 weeks ago actually. Not only that, but we might very well look at the whole June to date action as a possible cup with handle pattern. And even though I do not hold this to this view right now, I actually don't hold this view at all, and even a large March to date reverse head and shoulders pattern. One that seemingly failed on the follow through on the upside. The failure on the upside also affected the descending scallop pattern. I've retired both targets for this pattern. What we can easily see from the recent action is that yet again, the high at 429.50 from February this year has capped the market, as it did in early March and late April. So what can we now expect from this market? Well, the lows 2 weeks ago ended up being just ahead of the key 50% Fibonacci line for the important November 24 to February 25 move at 335.15. And back then, it had the pierced but unbroken assistance of the mauve medium moving average, currently at 336.70, as well as the rising green short medium moving average, currently 344.80. Today we are well over both, and we seem to have built a small base last week on the very slow rising gold long moving average, currently 352.60, after pushing up through it 2 weeks ago, when it was back then acting as a cap. All this action higher has left us with a number of interesting situations. For starters, we have filled in the changeover gap last week and now have just a far smaller one left over here between 407 to 407.55. Secondly, I now have the opportunity to draw a dark blue beginning of August to late September bullish Andrews pitchfork. Now I know some people don't like doing that on continuous charts. I do. The market is today, as it has been since its inception, been running along the dark blue lower time, currently at 361.95. I have some doubts about this pitchfork. It is quite an acute bullish angle and would have no issues, none at all, in finessing it to a shallower bullish shift pitchfork. at perhaps some future date, or maybe not so future date, maybe closer than we know. Now, there is something I'd like to look at here, and for this I am indebted to Ray Bradbury for asking me about New York coffee futures 29 weeks ago, and I went at that time to my longer term charts, the monthly charts, where we can see some possible insights. You see, on the monthly longer term charts, I noticed back then a pattern that had not been immediately obvious to me at the start of 2025, when I earlier reviewed the longer term charts, is a multi-year 2012 to 2024 very large reverse head and shoulders bottom for a bright red neckline on my chart, currently at 276.25. The break higher over this neckline reached its primary target on the upside, but there was a secondary much harder to reach target up in the 433.35 area. What was interesting about this secondary target was that nearby to that higher level was the next 100% projected Fibonacci line here at 433.75, quite close in the scheme of things. Prices did indeed turn lower, up at this key combination of the 100% projected Fibonacci line and a target at 433.35, dropping down through and closing below the important 50% projected Fibonacci line at 347.20, and below the May 2011 high at 308.90. However, in July and again in August, the market started to form a base at the top of the bright red neckline. August, with its monthly key reversal up, raced all the way upwards, and we saw an extension to that move up in early September, but not reaching quite as high as we saw back in February, important point, before dropping lower and setting up September to be a monthly bearish harami. However, since then, we have not carried on lower, at least not yet in October, as prices have started to move back up, and right now look like a monthly bullish thrusting pattern that's verging towards being a monthly bullish piercing line pattern. The top side now has resistance between 317.25 to 375.75, and possibly then again at the old broken upper time, which is currently at 391.5, of the former 2019 to 2023 bullish Andrews Pitchfork. Now, I personally don't favour this resistance, not much. Meanwhile, on the downside, then the real key will be the bright red neckline, though the 50% projected Fibonacci line at 347.20 does look interesting. I should point out one more final feature on this longer term chart: the possibility that we may form a very large bullish halfway hesitation or a very large possible double top, with all the implications these patterns may have. I will not discuss this last point any further, whichever one of it is, as it is way too early to isolate which one it will be. But in all of this, I ask you, please remember that these are monthly charts, longer term charts, in some cases very long term patterns. London coffee. 22 weeks ago, I said of the bearish pressure on this market, and I quote, "They now have the overhang of the market from roughly 5,300 up to this year's high at 54.89 sitting above." End of quote. This overhang of bearish pressure and ammunition is important, as it started back then to press lower, highlighting the impactful force of the break below an older, shallow, large bull channel, reaching both the primary and secondary targets below. The rise since early August pushed up through some significant resistances, now turned into supports. And more so, these are some keen, relatively close to the market supports. Notably, the trio of interesting 50% Fibonacci lines for November 21 to February 25 move at 38.08, the May 21 to February 25 move at 36.49, the March 20 to February 25 move at 34.81. Then there's a congestion of the 61.8% Fibonacci line at 41.68, and also others at 41.87 and 42.90. Some of these are now back to being resistances, but others are still supports, as in the declining, pierced, but still valuable mauve medium moving average, currently at 40.50. Above the market, we have now some former supports that are now once again resistances, notably at the 50% Fibonacci line for the February 25 to date move at 45.05. That was tested and saw a single close over last Friday, and which is still active as resistance today. Further up, we have the gradually dipping gold long moving average, currently at 46.87, which eroded a lot of the bullish incentive in September and late August, and not too far away lesser Fibonacci line at 48.22. I suspect the most important of all is just above the market, and it is the capping dark blue February to date downtrend, currently at 48.11, which made a lower second high in mid-September when compared to the late August high. Together, they have started to form a double top pattern. And I even laid out some, not targets, these are not targets, but potentials 2 weeks ago, of a primary potential down at 38.60 and a secondary hard to reach potential down at 36.40. As I said about these potentials 2 weeks ago, and I quote, "These all presuppose one key feature, and that this is not a false break lower, below the neckline at 42.50, which does not look like a done deal just yet. The congestion between 41.68 to 41.87 and the mauve declining medium moving average, currently 40.50, are short of a true break lower. Now we wait to see the impact of the 50% Fibonacci line at 45.05 and also the declining gold long moving average, what they both may bring."
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.